we've got a lot of data coming out. The fog is clearing. It's starting to get a dot plot. We're going to see what everyone's thinking. We're going to get the cut. And then we have this tailwind of the one big beautiful bill going into next year. What does that mean for us in the mortgage industry? Banning our money supply because the Fed has been restricted. I'm going to explain that. Credit card loans, car loans, those are short-term borrowing rates, and they are low right now. Microsoft and Google came out and said, we're not going to reduce our billions of dollars of spending. Existing home sales, 4 million home sales annual rate. That's with a little drop. Hey, it's KP coming to you live from Corona, California. Super busy week, got a lot to talk about, so let's get into it. I am going to tell you about monthly mortgage payments trending down, rates trending down, purchase business being up, what's going on with LO comp, and a big bet I made on Nvidia, and some comments from Ed Yardeni. But it's Fed week, so the fog is almost lifted. So if you remember from the last meeting, we were in a data fog because of the government shutdown, and we're starting to get some reports, right? We got the September personal consumption expenditure last week. So it's a little stale data, but the trend is important because inflation is something we've talked a lot about this year. Ever since the tariff kerfuffle back in April, a lot of people still talk about tariffs, and rightfully so. I mean, it's not nothing, right? But obviously less than feared. So I'm going to give some positive information here with a dose of reality and data. If you are doom scrolling and looking for bearish stuff, you've come to the wrong place. But our circles are small. Here on my videos, we had our Mortgage Banker Association IMB network call today, and Mickey Schilling is now my co-chair. So RIP Eagles playoff chances. My past co-chair Jason Stenger, if you're watching, sorry, buddy. They lost in epic fashion. I mean, they're still 2 games ahead of the Cowboys, but they could do it. And then my Longhorns are the best 3-loss team in the nation, as Notre Dame opted out to play like a champion in a bowl game. But I digress on all the football stuff. Core PCE index, core, which excludes food and energy because it's volatile, only rose 0.2%. Now, it's kind of a myth because energy has not been volatile. It's been low all year. I mentioned this on my last video. People love cheap gas. I ask every Uber driver I'm in, took my last work trip over the weekend, and yeah, I'm done traveling for the year. That's kind of nice. But every Uber driver, I've talked to them about gas, asking what they're feeling, kind of poking around, making friends out there. Did you know you could favorite drivers? I don't know. Didn't know that. That's on Lyft, by the way. All right. So core PCE is 2.8%, down from 2.9%. The headline number, obviously a little, a little bit better because we had the energy component in there that I just spoke about. Okay. So personal income rose 0.4% from August to September, matching expectations. So this clears the path for the Fed to do a cut, which they've talked about. This clip on CNBC from Ed Yardeni, you got to check it out. It's a very measured approach. He calls it the FOMC, the Federal Open Mouth Committee. They've been telling us what they want to do. They've been telling us what they want to do with their 3% neutral rate. We're at 3.875 currently. And so the market, again, is getting out in front of and saying, all right, this is where rates are going to go. So 25 basis point hawkish, slightly hawkish cut. And something that will be talked about is kind of the plumbing of our economy and how things work. And it's very important. It's something that people don't talk about. So SOMA, the Systems Open Market, what do they call it again? I apologize. I looked it up earlier. System Open Market Account. My bad. I should know that off the top of my head. I apologize. I looked it up. The SOMA account is like how the Fed, greases the skids. Is there enough money on their balance sheet to grow our economy? And so we talk about like this liquidity crunch. And so at this meeting, not only will there be a dot plot, the summary of economic projections, which is super important, right? We're only one person away from saying, the cut should happen, and where is the GDP going to go next year? GDP matters. We've got one big beautiful bill coming out that's front loaded with a lot of stimulus, and we did not get our deficit and debt under control. And so we have to grow our way out of it. So if we are going to grow this economy, there needs to be a certain amount of money on the Fed's balance sheet to be able to help sustain that growth. There's like some plumbing that goes on behind the scenes. This SOMA, this open market account, if they start buying $10 billion a month in treasuries, remember they were letting $60 billion a month run off. Like when they come due to maturity, they just let it run off. And that's how they shrunk the balance sheet as our economy was shrinking. And so now the economy has gotten to a point where it's expanding, and it's expanding beyond the $6 trillion, let's say, if you will, balance sheet of the Fed. So now when $10 billion rolls off in short-term bills, right? There's bills, notes, and long bonds. They're going to buy. They may announce $10 billion in buying. Okay, I read this from the good people at Mizuho. It was really, really great article put out there by Stephen Ricciuto. Did I get your name right, buddy? He's Ricciuto. So it's interesting. It's not quantitative easing. I'm not going to say stealth QE or QE light. If they just expand a little bit of what they rebuy when something runs off, they're just making sure the balance sheet has ample reserves to fund a growing economy. Now, if they were to do something like 60 or 80 billion a month in buying, that's true quantitative easing. But it's important because we have the flow of money. We need some velocity of money. We need this economy to grow. We got to get through this. Companies are growing. Earnings are growing. The Mag 7 growing, best businesses in the world, arguably. I'm not a financial advisor. I'm not responsible for your losses, only your profits. That's a legit disclaimer. But these companies are doing well. Ed Yardini thinks that healthcare, financials, industrials will do better next year because every company is becoming a tech company. Every company has to incorporate tech. We talk a lot about AI. We're talking about AI governance right now because we're all implementing AI to get, to do more with less. And enable our people on our teams to be more efficient, not replace them. And it takes a conscious act from leadership at companies to make sure that that is your company's mantra. And so, we need to make sure there's money in the system to be able to work through this. I think Nvidia is going to do well. I made a big bet on them when it hit 174. We'll see if it rides out between here and say mid-January. It's still a great company. Just was announced today. The Trump administration will allow some of their chips, Nvidia chips, to be sold in China, although China hasn't said they would do it with a 25% tariff. But every quarter when Nvidia announces earnings, they put zero revenue in for China, which is obviously a huge market. So you're going to see these chips start to make their way into businesses, into healthcare, which, by the way, we have an election we're going to be talking about like pretty soon here. We're going to the midterms a year from now, less than a year from now. And so I think this administration wants to extend the Health Care Act, the Affordable Care Act, also known as Obamacare, for another year to make sure that people have health care. And so that is a built-in money machine for healthcare companies who are getting better and more efficient using technology. And so there's a lot to be said about where we're going in 26. There's a lot of tailwinds, but inflation is still a fear. So this PCE report, although from September, is promising, which clears the cut for this meeting this week. And Stephen at Mizuho wrote something pretty cool. He said, the rate cut group sees weakening employment and the uncertainty created by the government shutdown as a powerful reason to take out additional growth insurance. And so I thought that was an interesting way of putting it, that we need to make sure that we grow, and you don't grow when people lose their jobs and their income goes to zero. That's actually very deflationary. So a lot of balls in the air. Bank of Japan talking this week. They're headed for a debt crisis. UK is headed for a debt crisis potentially. So, it matters what our rates are and our treasuries are sold for around the world. It matters because, we compete with other central banks. So the 3-month core is down to 2.6. That's down from 2.9. The 6-month is slightly up 2.7. But I read the bow tie economist, Elliot Eisenberg, just put out an email tonight saying that if you took an annualized core 3-month PCE run rate, okay, that's annualized, we're at 2.2 inflation. Now, that's not to say that we're going to stay at that all year round. We're kind of choppy. but the trend for inflation has been down, and so has rates. So some of us get emails from Kurt Loomis at eXp Realty. He's got some great data. He put out a very cool chart showing the monthly mortgage payments are trending down since May, $2,860 average monthly payment to $2,466. That's, what, $420-ish, $420 Elon line, which might be, by the way, where the 10-year Treasury goes up to, or maybe $425 when you buy in the rumors, sell in the news after the Fed does their hawkish cut and says we're going to pause and wait. Of course, we're going to wait until data comes out, which is next week, which may bring it back down if it continues to weaken. So rates are getting better. I read something today that said, rates haven't gotten that better. Yes, they have. Purchase business like the best it's been since early 2023. It's the second half of the year. People don't buy houses right now. It's freezing. The forecast the next 6 to 10 days for those in the Northeast, you're going to get the coldest air ever. Some polar vortex is coming through. So come on out on the West Coast. It's nice and warm. Anyway, refi index is up. Yes, refi business is a nice tailwind, but that may pause after this Fed cut, because every time we see a cut, we see a sell on the news. So bonds sell off because now it's like, okay, they cut. They were slightly hawkish. They said we're going to pause and wait until we get more clear guidance to really start cutting some more. But if you look at the CME tool, it says all the way through December next year that we'll get down to around 3% on the Fed funds rate. So, there are more cuts to come next year. It just might take a little bit of time. It wouldn't make sense for them to pause this meeting and then everyone expects in January, especially if the bias for labor, which all this data we've been seeing, is weakening labor. Who's ever heard of Revelio? Now everyone talks about Revelio. We have a weekly ADP jobs report. Who even looked at that, right? We look at Challenger. We got JOLTS data coming out tomorrow, which is actually a BLS data point. That's actually a pretty big one. So we've got a lot of data coming out. The fog is clearing. It's starting to get a dot plot. We're going to see what everyone's thinking. We're going to get the cut. And then we have this tail end of the one big beautiful bill going into next year. And so what does that mean for us in the mortgage industry? It means that the borrowers who have been watching since May, interest rates come down and stay down. Even if they go up and down, we watch the stuff day to day, week to week, whatever. Rates have trended down. The spreads between the 30-year fixed rate mortgage and 10-year Treasury yield has come down. Rates staying lower for longer has an effect on borrowers where they are ready to pull the trigger. They're getting their affairs in order. And oh, by the way, after all these existing homeowners pull their listings off the market, which I saw some negative press about that, of course they are. You don't want some stranger running through your house between Thanksgiving and New Year's, but you might list it again next year. And next year, we get spring purchase season with the borrower psyche watching rates go lower. Get your AI house in order. Get your efficiencies built. Get ready. The grass is green where you water it, okay? Don't take a check and go somewhere else if you're looking out there, because you did all this work to get ready. You know how good your underwriting is. You know how good your systems are. And we're rolling into a huge tailwind of a 2026. By the way, there's also some regulatory tailwinds. Small dollar loan, obviously, balances. It's kind of wonky with the way LO Comp is set up. The CFPB is looking at some points and fees data, and they're trying to see if they can get some action taken to help us on the origination side be able to work through an LO Comp change, especially for smaller loan amounts. Think it doesn't matter? Look at HEA, HEI, look at equity lending, look at smaller loan amounts. If there's rates come down, 3D printed houses, tiny homes, we start to see some more affordable houses come in. Listings are much higher than last year, even with people pulling off the market. There's good inventory out there. So we've got a lot going for us. So could get an LO Comp change. And one last little piece of information. The LOPAs are being looked at. Maybe the FHA monthly premium number comes down. That's a nice tailwind for a nice product that's subsidized by the government. Maybe not the life loan premium will come down. We have a lot of things going for us. So this isn't like a predict the future 26, but I'm just saying we got a lot of stuff going. On that note, the next 2 days, we have our budget meetings here for all three of our channels, wholesale, correspondent, and retail, and we will be setting our budget and numbers and picking, our path and all of our high points and low points this year and looking forward into 26. I know a lot of companies are doing that right now. So if you saw, today is the 45th anniversary of John Lennon's death, RIP. But even more importantly, We celebrated over the weekend remembering the attack on Pearl Harbor, and I believe the last known survivor from the USS Arizona, that ill-fated ship, recently passed in just the last few days. So, RIP to all those great servicemen, and we know that our civilian guilt is real, but we can do our job and help build our communities. So let's do it. Get back to you on Thursday after a Fed meeting and all the information. Thanks for sticking with me. My small, closely curated circle of people that like to watch my videos, even if they're long. Cheers. Hey, it's KP coming to you live from Corona, California. Busy day today. Fed cut and rates went down. And I don't know if anybody expected that. And I will go a full breakdown on the entire press conference that I watched, took some notes along the way. So you don't have to. I will tell you, one of our retail teams in a Teams chat said, everyone get ready to lock your loans. Every time the Fed cuts, rates go up. And I said, well, you might want to hold off because, we're at the upper end of this range. We've been range bound between 420, the Elon line, or as Bill Bodnar likes to call the Snoop Doggy Dog line, and 4% on the 10-year Treasury. And we were kind of bouncing around the top. And so, we're kind of range bound. Everything was really expected. A hawkish cut was expected. But the press conference was dovish. And I'll get into why. Not overly dovish, but not as hawkish as people thought, and certainly not as hawkish as the last one when they said, it's not for sure what we're going to do in December, and we've got this fog of data, which I talked about the fog being lifted, and then they cut. So, and now we have some dots, and we'll get into all that. But let me set the table real quick. So GDP for Q3, we do have a final read coming out in a little bit later this month, but, I think December 19th, you get the final read, but we're 3.1%. That's up from 2.8%. That's a growing economy. Anything above 2% is a growing economy. And that was part of the table being set for the press conference, a positive thing, right? And preliminary Q4 numbers I took a look at. We got Atlanta's Fed now saying 3.5%, down from 3.8%. And then the Philly Fed saying 1.1%. So we'll see. The dot plot, the summary of economic projections, where all the Fed members say, this is where we think GDP will be next year, 2.4% by the end of next year. So they see growth next year. And so, again, before I get into all the dots and all the stuff, more table setting. Job opening and labor turnover report is one of the first Bureau of Labor Statistics reports that we've seen for data. I believe it's the first one since the government shutdown ended. Or they shut that down. They didn't have good data. So there was almost 7.7 million job openings, which is higher than expected. But hiring has slowed and quitting jobs has slowed. And those are not good signs, even if the opening is a little bit higher. And we all know from continuing claims, which we will get tomorrow, weekly jobless claims, and then, of course, the continuing claims number, it's been harder for people to find jobs. So between now and the January meeting, I think it's like January 28th or something like that. I'll get the exact number in a minute. There's a lot of labor data. Like, we're going to get half the October report, the establishment survey. That's not the one where we get the household survey because it's kind of hard to get. We'll get a full November report, a full December report, a bunch of inflation. We're going to get a lot of data between now and January. So ADP weekly jobless claims was 4,750 jobs created in the prior 4 weeks. So this is the table of data set before the Fed spoke. And once Chair Powell started speaking in the press conference, that's when rates started to improve. So again, you have to look at the flow of money and watch technicals. The guys at MBS Highway, they did a great job. Barry and Dan, everyone on the team, they had a floating bias going into the press conference, and they said, get ready in case it's a hawkish cut, that we would send out an alert to lock in case things changed in the press conference, because the press conference is the part where you get new information that is hard to anticipate. And rates got better, so they kept floating. And our locks today were down from the average of this month. So people are building a floating lock pipeline. It's middle of December. Like, people don't buy houses right now generally. So I keep reading these articles about purchase money being down. And it's like, no one buys right now. They buy in the spring. Refinancing activity, it's great. The MBS Highway market recap for today was pretty interesting. They said purchase volume fell 2%, but it's still up 19% year over year. Refinances jumped 14% and are up 88% year over year. Who is out there talking negative about loan applications and rates and activity? This has been a fantastic end of the year seasonally. And so will we catch the same kind of lowish rates? Rates are great. Rates are great. The spread between the 30-year fixed rate mortgage and the 10-year Treasury, it's been improving all year. That's been a nice tailwind for rates. The 10-year, 2-year Treasury yield curve, remember when it got inverted and that was a sign of recession? It's been hovering at a positive 50 basis points as opposed to being inverted. It got as high as 59. If it's to come back down, a little mean reversion, come back down to 50, we got about 10 basis points of room for the 10-year Treasury to come back in line. So will that 409 number become the new ceiling, or is that going to be the floor? I don't know. It really does depend on labor data, which is what the Fed said today. They said something very interesting about jobs. They said that jobs are being created at about 40,000 a month, and they thought there was some distortion in the data and it was inaccurate. And they saw 60,000 jobs with their data because they have data. They don't care if the BLS is closed. They got data too. They all have these Fed groups, all these economists, and they know all this stuff in the regions. They get together. There's 60,000 less jobs. That's negative 20,000 jobs created a month. That's not where they want to be. And so we'll start to get some more unemployment rates later. By the way, they changed their language on this statement versus the last statement. And they said that the unemployment rate is not good, right? So Fed statement no longer calls the unemployment rate low. The word low was striked. It's no longer low. And I've been saying this for the last couple, months. We've been at 4.4, which if you look at their dot plot for months and months and months, they had like 4.3 in the year. And 4.4 is higher than 4.3. So it's no longer low. Labor is a concern. Inflation's not as big of a concern. Are you still concerned about inflation? They look at core PCE. They think at the end of next year, core PCE will be at 2.4%. And in 2027, 2%. Now, of course, the dots can't tell the future. Who knows what's going to happen? But they don't seem to think that tariff-induced goods inflation is going to last. It is kind of, what they've always said. They think it'll kind of work its way to the system for a one-time price increase through Q1. So what does that mean? What that means is, if that's true, we'll see prices go up to whatever they're going to go up to. And like I've been saying since the tariff kerfuffle, you don't have to buy more expensive-ish. If it's more expensive and you don't have the money, you're not going to pay for it. So we'll watch that. Commodities inflation. Mike Fratantoni did a great seminar today together with MGIC, and he was showing that commodities were upticking. Look at Dr. Copper. It's going up. That's a sign of future growth. We have this huge One Big Beautiful Bill that is going to have a lot of stimulus, and that is going to help stimulate the economy and keep GDP high. So, the Fed said we're at the high end of neutral rate. What does that mean? If we're at, between 350 and 375 on the Fed funds rate, let's call it, 3 and 5/8, 3.625, okay? The 2-year Treasury is at 360. They're probably not going to cut right now. The 2-year Treasury has to come down a little bit on the yield if there's some fear of some slowing in the economy or some more labor weakening. But for now, all this capital expenditure, even Chair Powell's talking about AI today. He's talking about AI and worker productivity being up. Wages in this employment index that came out today were not growing as fast. And that is a concern. If wages don't grow at a rate to keep that spread between inflation growing at a rate, well, then there's a concern. But if inflation comes down and that gap between wage growth and inflation growth stays the same, it can all come down, but that's still because of, weakening labor, which is not good. Shelter component of inflation has been coming down steadily since 2023. It just keeps coming down. And that's been the biggest part. Don't take your eye off the data. Don't listen to the stuff you read. Remember, 5-to-1 bias to read bearish and not positive news. I'm not trying to be Pollyanna or rose-tinted glasses. I'm just looking at the data. $2.2 trillion a year next year is what the MBA has forecasted. That's up. That's up, 7-8% on dollar volume? And of course, we know that we get little bumps here and there from refinance activity. Now, the last 2 years, this year and last year, September to December, that's when the Fed cut, and then they didn't cut. January all the way to the following September. I don't know that they'll cut in the coming months. I think Fed Chair Powell just had a swan song, and now he's a lame duck president because there'll be a new Fed chair announced. I thought Trump would troll him and announce it right in the middle of the press conference, but I guess he's being respectful. We'll do it, in January is what I keep hearing, or maybe it's, maybe the candidates that are the top 3 short list were doing mock press conferences to audition for what would they say if they were doing this conference. I don't know. Who knows? But, the bond market leads the Fed's actions. And if you go look at the CME Fed Watch tool and where they think the cuts will be next year, the Fed dot plot said there'll be 125 basis point cut all next year and then one more in 27. The bond market does not believe them. As of today, as of this not super hawkish cut, a somewhat dovish cut. And so they feel that liquidity is going to be coming back commensurate with the size of the growing economy and GDP, and we're having a soft landing. And so if you look at the CME tool, there's like a 50-50 chance that in March 18th, so the January 28th meeting, then there's a March 18th meeting with another dot plot, that there will be another 25 basis point cut by March. I'm not sure about that. It really depends on labor. And then some of this data I'm looking on the CME tool says, by June, there's a good chance of it being 2 cuts. And, if you go all the way out to December, you look at next year, it's definitely 2 cuts in this year when the dot plot says 1. So we'll keep an eye on that data. There were 2 dissents, but 6 members wanted no cut. 7 officials wanted no change next year. 11 officials only want 1 cut or less next year. So 3 total dissents, first time since 2019. And before the meeting, there was 8 dissenting votes in the last couple of meetings. You have to go back and add up the results of 47 meetings to match the 8 disagreeing votes we saw in the past 4 meetings, and now you got 3 more today. So, when that change happens, and it's supposedly a dovish board where, you've got someone who wants to be more accommodative, we'll see where that neutral rate goes. The neutral rate is where they feel the Fed funds rate needs to stop, currently at 3.4, so call it, 1 more cut. For an economy where inflation and the inflation and employment mandates are in balance. So we'll keep an eye on that. And now I'll add one more thing. They did say that they were going to purchase short-term bills, which I mentioned on my video 2 nights ago, which, by the way, thank you. I had something like 27 hours of watching my crazy video, so I had to throw one out here tonight because people, I guess, are digging it. My small little curated group. I don't go for follower count. I go for impact. So, if they're going to buy short-term bills on an ongoing basis, that is to keep the level of reserves ample. So, some people thought they would buy, $10 billion a month, maybe $25 billion. They're doing $40 billion a month in short-term Treasury bills. Their balance sheet is loaded, okay, at $6 trillion with a lot of long-term debt, okay, 10-year Treasuries, 20-year long bonds, 30-year bonds. That stuff's not running off. But to keep the SOMA, remember I was talking about the open market account, to keep liquidity in there between now and April 16th, when we get our tax revenue, which is the biggest, I think like $2.5 trillion in tax revenue, they need money in case there's some kind of liquidity crunch for any of the banking institution, keep our financial institution afloat. So they're going to do $40 billion in Treasury short-term bills, right? There's bills, then there's notes, then there's bonds. 10-year is a Treasury note. And the 10-year auction was great today. And so they're going to keep growing that account to make sure that there's enough money to pay for our government, which they know is going to spend a lot of money because now everyone's going to start talking about, well, we're not being fiscally responsible. We're growing our debt. We're growing our deficit. How are we getting out of this? Well, this administration wants to grow out of it with GDP. And obviously, we all hope they can do that. If all these rosy things happen, we might have seen the lowest in rates are going to be in this part of the cycle until labor does materially get worse from here. So for rates to really get better than what we've already seen, labor has to weaken, or else that might be it. And if they stay in this range right now, 6.3%, 6.35, 6.4, 6.25, that's a great rate. And the longer borrowers look at that as we cruise into spring purchase season, they're going to want to buy and pay for that. I'll add one more note. 41% of rental stock, okay, 18 million units,
are in high-risk disaster counties, according to FEMA. And I read that on the Harvard Joint Center for Housing Studies. So, we want to take these renters and move them into purchasing as a first-time home buyer, but a lot of them are at risk, climate risk. So, don't get weird about, climate risk. I mean, it is an actual risk. If there's a fire or a storm or hurricane, it's a real thing. And so, something to think about. We've got a lot to think about. We're planning for 26. It's going to be a growth year. Let's freaking go. Have a good one. Goodbye, Chair Powell. Cheers.
You've been listening to KP Talks Dollars and Cents, a top-rated show for those who want to learn about the economy and mortgage environment. Tune in each week for more episodes, and please leave us a 5-star review on Apple Podcasts and Spotify. Kevin Perenio does not render or offer to render personalized investment or tax advice through KP Talks Dollars and Cents. The information provided is for informational purposes only and does not constitute financial, tax, investment, or legal advice. For more info, follow KP Talks Dollars and Cents on all of our social channels.